Good morning, everyone, and welcome to our monthly roundtable with Witham. Today's roundtable will be PPP, loan forgiveness, updates, and managing payroll with Dan Mayo, Principal National Lead, Federal Tax Policy for Witham, and Heather Sperduto, Vice President of Sales and Operation for ADP. To start us off, we'll have Terry Moncrief from Witham, who's also a partner. Good morning, Terry.
Good morning, Sean. Thank you for getting us started. Welcome back. This is our fourth month, I think now, of the Restaurant Roundtable. I appreciate you all joining us. We're trying to kind of get this thing rolling, make it more interactive, bring whatever events are current that we think affect directly the restaurant industry. So we appreciate your joining us today, and we hope we're bringing some content that's valuable to you. Please feel free to reach out to us. My name is Terry Moncrief. I'm a partner at Witham Smith & Brown. We have a whole team of experts in restaurant and food and beverage industry niches. So we're going to try and kind of keep this thing going. And again, like I said, any type of current event that's timely and that is appropriate to the restaurant industry is what we're going to try and discuss. So for this month, because it's January, beginning of the year, really end of the prior year, we thought payroll would be an appropriate topic, kind of all those issues relating to, any changes in W-2s and 1099s, but also related to the COVID issues and the COVID legislation and the new credits that are out there and available. So anything and everything kind of payroll related, maybe minimum wage and tip minimum wage. And Heather's going to kind of walk us through that. And then after that, Dan Mayo is back again, and I apologize, now our third month in a row talking about PPP, but they keep coming up with new legislation and changing this thing, so it's still an appropriate topic. We're going to talk about the PPP2. There's now a second phase of PPP, which is pretty big in and of itself, but in addition to that, they made some significant changes to the first phase PPP. So Dan's going to cover that too in the second half of our presentation. So we're going to get started with Heather. Heather Sperduto is a vice president over at ADP. She is extremely knowledgeable when it comes to anything and everything payroll related, but in particular these new credits and issues relative to the COVID legislation. I think before we get started with Heather, though, we're going to have a couple polling questions. You guys have been on this for the last couple months. You're comfortable and you understand. We'll throw in a couple polling questions just to get a feel for who's in the audience and what they're experiencing and what they're going through. So Alana, if you could put up our first couple polling questions.
Sure. Heather, I'm sorry, I'm going to have to share over your presentation just for the polling questions really quick.
No problem.
1 second, everyone. So to log on to Menti, I put it in the chat box. So it's menti.com, and you can put in the code 2130442. Let me just share my screen very quickly. Okay, so you guys should see my screen now. So the first polling questions, have you taken advantage of the employee retention credit? And again, it's menti.com, and so you use the code 2130442, and you can vote easily. All right, we'll give it about 30 more seconds. So again, menti.com, you can put that right in your browser or in your phone, and the code is 2130442.
Alana, I'm not seeing the results on the screen. Normally we see them kind of popping up and down.
Oh, maybe, I think because Heather, I think you're sharing your screen. That's weird, it should be, okay, hold on. Okay, do you see them now?
I knew Heather was going to be trouble.
There we go.
Sorry about that.
I think this is not surprising because of the relationship it had with the PPP funding, right, in the past.
Okay, all right, I think we have one more polling question, Terry, for this one.
Okay.
We'll go to the next one. Oh, wrong one. Okay, number 2. How did you react to the increase in minimum wage? So keep prices the same, increase prices, reduce workforce. So again, menti.com, code is 21304442.
It's a tough environment, I guess, to significantly increase pricing, but
Okay, we'll give about 30 more seconds.
Terry, I wonder if it makes any sense to have a little bit of dialogue as to why, the restaurants are not taking advantage of the credit, the employer tax credit.
the retention credit, I think we
retention
will, and I
credit.
think it's going to come up in both presentations a little bit later. But they were restricted in taking that credit if they took PPP money. And now there's been a change made. So they're going to be able to take that credit even if they had taken the PPP money. So it's probably going to be a relatively big portion of both presenters coming up. So that's the only reason why I didn't kind of want to step on their toes.
Mm-hmm.
But you're right, it's going to be important. This one's going to be big, I think. It's going to be helpful. All right, Heather, I think we're ready for you then.
All right, here we go. So I am Heather Sperduto. I run Point on the design and execution of the program that we have specifically with the accountant community across the country. And I think that's how I came into the mix with our close relationship with them, not only as a really solid partner, but also as a client of ours. And just compliments to you all on the Witham side as you help these restaurant owners and professionals really navigate what will probably go down in history as one of the most challenging times in this specific industry. So I am a fan from a learning environment. I typically travel all over the country, conferences and events. I do like to give you some visuals because I think from a learning perspective, Harvard Business Review always says you only learn 11% of what you hear, but you learn 83% of what you see and hear. So a little disclaimer up there, just want to give everybody a heads up. This is not legal or tax advice. And the final word on today's topics, we always consult you to tap into the final regulations that are out there. And by no means is this a political opinion. But here you are, like the master of your craft, whether it's the love of food, the love of the ambience, the love of entertainment. You all have so much on your plate in a given day, whether it's the connection to your vendors, keeping up with health and safety, managing costs, staffing, training, marketing, customer service, your menu. I love the fact that when I go to a restaurant nowadays, I just open my phone and the menu appears on my phone, and ultimately how you stay ahead of the competition in your particular area. But during these times, as we look at some of the trends, like this is only magnified. And if I could give you the landscape as we look at organizations across every spectrum, as we move and as we shift and look at the workplace from 2020 now to 2021, this newly transformed world of work now has a bigger focus than ever on diversity and how we take care of our employees and the safety measures, the compliance. And are there some relevant data and insights out there that can help you make really good decisions for the organizations that you guys run in that specific niche in the restaurant industry? So as I work and consult with business owners, in the course of the last, call it, now here we are, I think at the 10-month mark, right? There are businesses that fall into different categories, and we've seen those that have struggled. Like clear as day, there's been a layoff, they furloughed employees. There have been owners of businesses that, bless their hearts, they've been paying employees along the way as they were waiting for loans to come in. But ultimately, the thread that weaves into all of them is this rapid pace of changes in this legislative environment. So you have those that are struggling, you have those that are deemed essential. And guess what? All those businesses have been overwhelmed with the demand, and they've actually been in a position where if they're fortunate enough, they're onboarding and they're hiring employees. And then you have the third bucket that has something that consumers are craving, right? So they're adapting to new technology, they're forcing innovation in certain circumstances, and they're embracing this new world that in many cases is contactless or virtual. So when I look at all of you, I mean, you have spanned all three of these categories, and that's not the norm for a typical industry. So I wholeheartedly compliment you as you have been embracing every single angle that has come your way. So I mentioned data, right? And I wanted to give you some points, and this came from the Toast Restaurant Success Report. And when you look at that, that need for, and when I say data, how is it meaningful? It's one thing to look at numbers, but it's another thing to make it meaningful so that you can take action as you look at, having your bottom line grow. So almost half of restaurants, the scheduling piece always seems to be tricky, but 40% of restaurants have scheduled employees for fewer hours to offset some of those rising costs on the labor front. And in the event that you have to replace a worker, when you put the dollars and cents associated with it, it could equate to as much as $5,864. And in addition, sometimes you have to halt your onboarding or your hiring when you look at that overall cost of labor. So let me give you some updates. My job is to give you some updates so that you can see what's happening real time. And let me see, you can see that full screen right now, Terry? Is that good?
Yes.
Okay. I wish I didn't have to show you the unemployment rate, but as you know, data is our middle name at ADP. So whether it's the jobs report or the unemployment, but I thought it would be helpful to give you guys a glimpse specifically as we look at that hospitality industry. So clearly they've been higher than we've seen ever before almost. And in that work environment, I think the question is, how do we keep the business continuity going? When you look at things like capacity guidelines and managing your costs and streamlining the process, now all of a sudden you're all trying to adapt to new skills that comply with this social distancing. And then you have an element where many of your workers are tipped employees. And how do you handle the fact that some of the traffic has been slowed tremendously? Now, in the restaurant industry, when you look at wage and hour regulations, you probably have more exposure than anybody else out there in the market. You then have these magnified health guidelines and protocol, and all along adhering to the legislative updates. So in the restaurant industry, specifically on the quick serve side, and I don't know if any of you fall into that realm maybe as a franchise, but we do a lot of work with franchise owners, and they came to us and said, hey, can you give us some guidance on some of the best practices as we go out there and try to get really great people, and when we get them along the way, keep them? And by the way, any visual I share with you guys, you'll notice that there's always a website to be able to go out there complimentary and grab the resource that you could look at it in a little bit more detail. But things like staying visible with your presence there on social media, your website, what that looks like, the transition as you bring employees into the experience, and ultimately with all this stuff in the compliance world, how do you help them, your employees, the most critical asset to your business, also stay informed so that things move smoothly throughout the course? So your competitive wages, and I'm actually going to show you a tool real quick that will show you where you can access competitive wage data complimentary through ADP, and ultimately what it could look like as you build your brand and tell your story. So here are some of those updates. Map of the country, HR tip of the week. It's my favorite part of the day because I feel like every time I go in there, I say, oh man, I cannot believe I'm reading this and that this change is happening and business owners are going to have to implement it in a hot second. So in ADP's HR tip of the week, here's a map of the country. 20 states have changed their minimum wage going into the year 2021, along with 30 cities. So on our side in New Jersey, right, I'm assuming you all are aware that the minimum wage is going up to $11 or has gone up to $11 per hour. And then on the tipped worker side, it's also gone up from $3.13 to $4.13. Okay. And we asked the question, Terry, the polling question that came up with, hey, are you increasing your fees? I shared with Terry the other day, my brother lives in California. And I'm always amazed in the California market. When we go out to dinner, literally, when I get the check at a restaurant in California, more often than not, I see on the bottom that there's a service fee due to increase in wage and hour regulations in California. So in essence, they're passing that over to the consumer, and it could be $5, it could be $7. But my dad and I were sitting there, my dad's a CPA, and he's like, look at this. They're just having us just pay right for all those increase in regulations. So I did want to make sure that you knew what that looked like. And hey, by the way, if you were to go to ADP/FAST, you could pull out this information for any of the states in the event that some of you spanned your presence beyond just the New Jersey market. Okay, so second thing on compensation. You know, in order to stay competitive, like, you know, it's about your culture and all that kind of stuff, obviously, but let's be realistic. Like the hard cents and dollars and how you compensate your employees is a critical piece to that component. So on our side, we look at 30 million records and 90,000 organizations. And this is kind of where your accounting firm comes into play. So for an example, Terry or Dan at Witham could come into ADP's experience that we call Accountant Connect. And what we do is we allow the firm to access the client's data with your authorization. But then we also have tools like this compensation benchmarking. And I had our data team pull an example for all of you that looked at a short order cook. So I can go in and I can pull a map of the country. I could then hone in on New Jersey, and I could say, okay, if I'm hiring a short order cook or a manager, you know, what are those income levels that are at the national average, New Jersey average, but then if I'm in Monmouth County, I could drill down even further and look at those data points. And then the reporting follows true behind it. So you can also analyze things like, you know, overtime or benefits and ultimately get this dashboard view. So our clients on occasion, especially the bigger ones, have access to this, but we also put it in the hands of the accountants because as we serve up the data, you know, a firm like Witham, they come in and that's where they do the consulting and the advising to help you all make really good decisions. Okay, so last thing here for me is I get ready to turn it back over here to Terry and Dan. With this new Consolidated Appropriations Act that was enacted at the end of December, I want you to consider some of the impacts. So I'm giving you a visual when the world decided that it was going to change itself back in March, right? And the government instantly jumped in and said, okay, we got to figure out how we're going to help people out there, business owners, individuals. March 18th was a big day, right? Because the Families First Coronavirus Response Act came into play. But then following suit, you then had the Coronavirus Aid Relief, which was the CARES Act that came into play and came to fruition on March 27th. Now you go a month later and you have PPP and the Healthcare Enhancement Act. You then had the paychecks or the PPP come into place on June 5th. And now we find ourselves with this whole new Consolidated Appropriations Act. So I've been at ADP since the day I graduated college. What this has meant for me is that we have made 1,000 changes to our system based on 2,000 regulation changes in over 60 countries. And when we look at the loans, we were instrumental with over 400,000 clients tapping into our reporting to then go out and secure over $115 billion in loan revenue. So Dan's really going to take you through some of the things pertaining to the loans, but I also just thought it would be good to give you a visual as you look at some of the changes that are impacted. It's on eligibility, the loan amounts, if you are taking the loan for a second time or a second draw, what the eligibility costs look like, and then what's happening on the forgiveness side. So my piece is just to give you some of the nuts and bolts pertaining to this employee retention credit. In the CARES Act, and it's not surprising that we didn't see a ton of people originally that were jumping into this credit. Originally, the eligible employees were allowed to take the credit against the employment taxes up to or equal to the 50% of the qualified wages. So that was up to $10,000 in wages for each employee, $5,000 maximum, right? Now, available with respect to wages that were from March through the end of the calendar year, okay? And when you looked at qualified wages, more than 100 employees, the credit for the wages paid to the employees not providing services during shutdown. And then if you had under 100 employees, all wages there would be qualified, okay? So this is like the old terms, and you can see on the right-hand side some of the logistics. The credit was not available to employees that received the loan under the PPP program. So that was probably the biggest thing that you're gonna see in a second has changed. Now, by the way, this is like one slide, guys. Last week, we had 15,000 people come to a webcast, and there were probably 50 slides that went over some of the 50,000 pages that are in this new act. So I just want to give you some perspective that, you know, it's a little complicated, right? But here's a summary of what you need to know. With the prospective changes, the credit is now extended through June 20th. The amount for the credit increased from the 50% up to potentially 70% of the qualifying wages. Okay, now the wage cap increase from 10,000 in the aggregate for all the calendar quarters to 10,000 per calendar for 2021. And if you're a larger employer that's joining us, for purposes of qualifying wages increased up to 500. So if I could like look at retro here, right? Some of the changes, the clarification that the group health plan expense may be considered even when no other wages are paid. And then the biggest thing is that PPP borrowers may be eligible for the credit to the extent that the qualifying wages are not paid using forgiven PPP loan proceeds. Okay, and then clarified gross receipts for certain tax exempt organizations. Now, with all of that said, and the mouthful, in pure disclosure, our systems at ADP, like we're still waiting on further clarification, right? Because what this means is, hey, am I going to go back? Do I amend some of the returns that were filed? Do I try to catch up in the next couple weeks? Do I have the earnings to capture it in 2021? So the point of today is to say, hey, this is on the horizon. These are all the proposed. And as we get further clarification on our side, you can bet your last dollar that as we get ready to issue 50 million W-2s on our side, if you are a client of ours, we'll have, and we do have the earnings code set up, we'll give you the step-by-step guidelines. And if you're using another vendor, I'm assuming the same will apply. So as I wrap up, here's like resources that all of you are welcome to take a look at. So whether you look at some of our articles, that HR tip of the week I mentioned, an entire landing page dedicated when you look at employee and safety and bringing people back into the restaurants, or specifically on the PPP side, you know, many of you are looking at the forgiveness side, there's estimator tools, you know, you are welcome to explore, to learn so that you can consult with your accounting professional and make the decisions that are best for you and your employees. So on my side, ADP, we're always designing for people. Every single one of us, we have different dreams, different goals, different reasons we're working really hard, and we're never stop reimagining a better working world. So, you know, your business, fast-paced, it's changing, it's evolving. My compliments to you as you continue to embrace your customers, My family, who frequents restaurants throughout New Jersey, I'm enamored at the way that you have reimagined what you all do in a daily environment and stay in sync with all of the changes that are coming your way. So that's my portion of the session. I am going to turn it back over to Terry, and I think Dan is up next.
Okay, thank you very much. That was an excellent presentation. Just a couple things. Number one, I just wanted to mention real quick, the minimum wage in Jersey, I believe is $12 an hour. I think you might have slightly missed.
Oh, I said, I'm sorry.
No, that's okay. I'm sure, believe me, most of the people on this call realize that already, I'm sure. And I believe the tip minimum wage is the $4.13, and you were right on that. And I know both of those, I believe, are going up $1 an hour for the next 3 more years. So, we've got that fund to deal with every January 1 coming up. Just a couple quick questions for you, Heather. And I think there were actually a few questions on the board as well. And maybe Alana can share those with us, but let me squeeze one in real quick. As far as relative to the new COVID legislation, is there anything we need to worry about or keep an eye out on before we file our 1099s or W-2s or fourth quarter 941s? I know this employee retention credit, and Dan will get into it a little bit more, that may possibly change our fourth quarter. But aside from that, did anything else quirky, unusual happen? I know there was some credits relative to, I guess, employees who you paid even though they were off with COVID related issues, right? There were some, so does any of that affect anything that we need to worry about in January relative to our fourth quarter?
So on our side, what we did is we set up a plethora of earnings that pertain to, if in the event I had COVID and I was unable to work, or I'm a caretaker, or as an example, my children are home from school, I don't have the capacity to be able to take from them. So all of those earnings credits are set up in our system, right? We've been advising our clients to continue to move forward as long as they captured the appropriate earnings and filed appropriately on the 941s and the New Jersey return. We're going to move forward to close out the year.
Okay, sounds good. If anyone else has any other questions, now would be the time for Heather. Alana, I know there were a couple questions, I believe, posted on the board. Anything for Heather?
Muted, Heather. Alana.
You want Shaw to jump in?
Sorry, it wasn't letting me unmute myself. Yeah, there was some in the chat earlier from, it says ERTC. I don't think we understand it well. Also, when it was 100 employees, it was limiting. Moving to 500 opens it up for more employers. Would really like if you could explain it in basic manner, not just what relief bill allows, but what ERTC and what kind of impact this will have.
The best example I can share is I saw a YouTube video this morning from an accountant up in Massachusetts. And in 90 seconds, he was really able to summarize a ton of businesses, employers, employees. The focus was really on PPP as we looked at the loans that were coming in the past months. And now this is an incentive that as the eligibility has changed, many more businesses are starting to say, hey, this could be another incentive, another tax credit that we should be able to take advantage of.
Yeah.
Go ahead, Dan, I'm sorry.
Yeah, I was going to say, as Heather mentioned before, the 100 and 500 rule, it did greatly expand it, because it used to be that in 2020, the rule is if you have under 100 employees, you can include the wages of all your employees as qualified wages. You can take a credit on every single employee. If you had more than 100 employees, you could only take a credit for the wages that you were paying to employees not to work. So there's a big difference there. In 2021, when they expanded the credit, what they said was if you have under 500 employees, you can get the credit for every single employee. If you're over 500, you can only get the credit for the employees who you're paying not to work. So that's one of the expansions of the tax credit, is that for now, for under 500, so probably many people, not everyone on the call, you can get the credit, the $14,000 credit in 2021 for all of your employees.
Yeah, and I know that's going to be that's a significant factor, and that's really going to help a lot of people. So Really, everyone on this call should look into that seriously.
Terry,
I'm sorry. No, I was just going to say, Heather, you know, I didn't invite you on this call to be plugging accountants up in Massachusetts. So
I know. I saw it like 30 seconds before it came up. I go, hey, this guy's pretty sharp. I will tell you this though. He runs payroll through our payroll engine. So he's actually, I think, a competitor of ours, but he uses our engine behind the scenes. But he did say in the video, hey, consult with your accounting professional to be able to help you out. So I think he was kind of neutral in his delivery of his presentation.
That's okay.
I'll shoot Terry. I'll shoot your YouTube video as soon as we wrap.
Hopefully it was one of our accountants from our Boston office, so.
There you go.
Yeah. Alana, were you saying something? I'm sorry.
yeah, someone put in the chat, to qualify for the ERTC, the way I'm understanding it, the employee is not working but still gets paid, correct?
Yes, so yes, that's correct. The employee's not working and you're paying them, you can use those wages as the base to calculate your credit. That's correct. Whether
Right, but they've made a change now, Dan, right? Going forward.
Well, that's going to be something. If you're paying the employee not to work, you could in both cases, 2020 and 21, you can get the credit. The break point was the point is that the break point was 100 in 2020. It's now 500 in 21. So if you were over 100 employees, it was very limiting in 2020. Now you have to be over 500 to be subject to that limitation.
Right, but at this point, you can also get the credit on employees you're paying that are working, right?
Well, you could before, but if you were, so yeah, so you could before if you were under 100 employees.
Right.
And right, and so yeah.
We got a few more. How does the ERTC work? Do you pay and get refunded?
Yeah, so the way it works is you don't, it's not a credit you pay to the employee. You pay the wages to the employee, and then you deduct it from your employment tax deposits that you make to the IRS. So let's say you have, you're entitled to a credit of $3,000, right? You paid $6,000 of wages, or well, let's use the 2020 numbers. You paid $10,000 of wages, you're entitled to a $7,000 credit for that one employee. The way it works is you reduce your employment tax deposits by 7,000. So if you owe 10,000 for that either week, month, or quarter, you can reduce it by the 7,000.
So is that an automatic, Heather, that ADP does? Is that a line item on the 941?
Well, that's what, last night I had a meeting, it was like 9 o'clock at night. So we're trying to set up our systems. We have the earnings code, we had that set up originally, and that will stay in place. What we're trying to see is like, what is the best course of action? Obviously, I don't think the IRS wants any of us going back and amending returns prior, more of a going forward basis. So literally, like, if you could imagine us with the volume of people we pay across the globe, we're trying to get our systems in place. So, I think at this point, this is more of like an awareness. I think the next week or so, you'll start to see some things that are more buttoned up in fashion. As a suggestion though, Dan, I think everybody's probably wondering about the loan piece to the equation. I don't know if you guys are, ready to take a look at that. And if you all have, like supporting communications or whatnot, we can follow up as well, like as our step-by-step guide comes into play, for especially if those of you that are clients of ours, we can make sure that we share that with all of you going forward.
Yeah, Heather, that would be excellent. Just forward it to either myself or Glenn. We have contact information for this entire group, and we can forward that to them as well. So yeah, as you get more information, that kind of buttons up exactly how to treat this. And you're right, when I first heard about this credit and the fact that those who took the PPP money are now eligible to also get this credit, my first thought was there's going to be some retroactive activity here. There's probably going to be some amended 941s back into last year, or can we somehow make a calculation now and take advantage of that in our fourth quarter 941 when we file that? So you're right, there's going to be there's some devil in the details, and we need to figure that out very soon.
I want the bat phone to the IRS. Last night I said, at this point, don't we just have a bat phone to the IRS to say, hey, as we make these changes, maybe we should look at some of the details that are going to go with it. It's in order to implement them.
Yeah, so the employee retention credit's been around obviously since the CARES Act, and it's been expanded in 21. There is an extensive amount of FAQs available on the IRS website. So if you Google IRS FAQ employee retention tax credit, you will get the first thing that will come up are those FAQs. So that most of that information for the old one will apply to the new one, except for the changes that were made. We expect the IRS will update that to include the new credit and the rules that apply to it and how to recover that 2020 credit if you didn't take it and are now able to take it. So that should be coming in the near future. Right, as of right now, it would be an amended return. Expect that they will have some kind of prospective adjustment, as Heather mentioned, to make it easier. So they're not inundated. There were 5.2 million PPP loans. This affects therefore up to 5.2 million taxpayers. I don't think the IRS is interested in receiving that many amended returns. So we'll see. So, but the point is there is plenty of existing guidance on the IRS website.
Thanks, Dan. Yeah, I don't think ADP is interested in preparing 5 million amended returns either, so.
Up for the challenge, but I sure as heck hope not.
All right, thank you. No, it was a good conversation. I appreciate it. I think definitely that's a very interesting and very important subject. That's a lot of the people on this call are going to be impacted by. So
Harry,
let's hope
we
in
have
the next couple of weeks. Yeah, I'm sorry, Alana.
We have about 3 more questions. We want to save them to the end and have Dan speak for a little bit, and then we'll go into more Q&A.
Yeah, why don't we get Dan started? I know we had, yeah, because I'm sure if they're related to this credit, Dan's going to be touching on that in his presentation as well, and we'll probably wrap up at the end with even more questions about this. So let's
Okay.
get Dan started. We had some polling questions, I believe, right? Heading into Dan's portion of the presentation.
Let me put those on right now. Okay, so you guys should see my screen. Again, you go to mentee.com and you can put in that code. So are you eligible for the requirements for PPP2?
So the PPP2 was a 25% reduction in your revenue for any quarter in 2020 compared to prior year, which I would imagine quite a few, well, some of the people on this call will qualify.
Okay, we'll give it about 30 more seconds and we just have one last question before we hand it over to Dan.
So yeah, 90% of the people on the call. That makes sense.
Okay, you want me to go to the next one, Terry?
Yeah.
Okay. All right, and this one, hold on, it lags a little bit. Are you currently using outdoor dining still? Still going on, took it down, never had it? Give it a few more seconds.
I was impressed. Heather told a story earlier of a very nice outdoor dining experience she had just a day or two ago. I was really worried the winter weather would kind of, squash this, put the kibosh on it, but it sounds like, and I've seen a couple examples of it still going pretty well.
Looks like it. All right, I'll stop the poll.
So about 50-50.
Yeah.
All right, Dan, thank you very much. You're up. The Dan's here again to speak about the PPP. Dan, from the last couple months, he's with Witham, with our National Tax Department. He's expert in federal tax policy, all federal tax policy, but particularly this PPP program. So he was instrumental the last couple months on the initial PPP and then the forgiveness application calculations. And then all of a sudden PPP2 pops up. And is a pretty significant program in and of itself and is going to help many of the people on this call. But in addition to that, it kind of adjusted how you treat PPP1. So that's why we asked Dan back to kind of fill us in on all of the changes in the PPP program and some of the new PPP2 issues. So Dan?
Great, thanks, Terry. So there've been a tremendous amount of changes to the PPP. I'll sort of tick off some of the major ones, discuss briefly some of the rules, and then open it up to Q&A because it's usually more helpful, I think, to people. So we know that the CAA, Consolidated Appropriations Act, was passed December 27. The IRS and the SBA issued guidance on January 6th, and on January 8th, the SBA came out with updated loan applications. So for upsizing PPP-1 loans, there's a limited upsizing opportunity, and for new PPP-2 loans, those applications are now on the SBA website, Treasury website. That's where I tend to look every day. If you type in Treasury PPP loan, it's the first hit that comes up usually, and that's where you'll see all of the PPP guidance from the SBA. You will see all the applications and instructions and the forgiveness applications. Again, just type in Treasury PPP loan, it usually picks it up. We're expecting more guidance to come from the SBA in the term of more IFRs, interim final rules, and we are expecting guidance from the IRS. And if you have not yet applied for forgiveness on PPP-1, and your loan is 150,000 or less, there's a simplified application coming out in the next week or two from the SBA. So simplified application procedure. It's going to be a one-page certification, no numbers. You just certify that you met the rules for the program and you would have gotten full forgiveness, and that's enough to get to forgiveness. So an easy application coming out very soon. Okay, so the covered period rules have changed. It used to be 8 weeks or 24 weeks. It's now any period in between. Just clarifies it, makes it easier. So, if you use a 24-week covered period, the wage cap is 100,000 times 24 over 52, right? 24 out of 52 weeks. So if you use a 16-week covered period, it's just 100,000 times 16 over 52. So you get to prorate that wage cap is prorated to the covered period that you use. There's an expanded definition for permitted non-payroll costs. So it includes the cost for PPE. It includes some costs if your business was damaged by those, riots in response to police behavior. And it covers certain software or cloud computing expenses you may have incurred. So that non-payroll bucket of up to 40% of the loan forgiveness amount can now include other things beyond interest on covered mortgages, rent, and utilities. You can now include these 4 other non-payroll costs. There's a reopening of PPP-1, as I mentioned. Congress allocated $35 billion for this. And so who can get this? So this is for people who either didn't apply for a loan and they were eligible, but they never applied, or you applied for a loan but got nervous about the program for one reason or another and returned the money, or you applied for a loan but didn't get the full amount. So let's say you applied for the loan, got 100,000, but you're really entitled to 150, the way the final rules settled out, but you only got that 100. So then you can go back and get that extra 50 under PPP-1 and also get a PPP-2 loan. So there is opportunities here, like with the employee retention credit, you can go back to 20. Here you can go back and reopen your first round loan and also get a second round loan. The upsizing does go through the same lender that you got the loan, but on the second round PPP-2, you can go to any lender you prefer. There is a minor benefit to going to your existing lender if you want to use your 2019 payroll data. You don't have to provide new data to the lender. Otherwise, you're free to go to any lender you want. Many people were unhappy with their lenders, so you can switch. It's an opportunity. You're not required to go to the same lender. We talked about the simplified loan forgiveness, 150,000 or less. That applies to PPP-2. Also, PPP-1 borrowers who have not yet submitted their application for forgiveness. If you have submitted it, obviously it's not going to be of help to you. So PPP-2, what is it? They allocated $284 billion. It opened, the portal opened yesterday for a limited subset of borrowers. We expect it's going to open later in the week for everybody. The question is when lenders will be available and get their systems and their portals open. So we expect them to run out of money as well, like they did last time. If you recall, last time they opened April 3rd, I think it was 13 or 16 days later, they ran out of money. Here they have less funding, the smaller loan size and smaller pool of applicants, but restaurants and hotels and others with that code 72 can get 3.5 times their payroll, not 2.5. We'll talk about that in a moment. So there's some loans are going up, some are going down, but it's not clear what that net effect will be, but It's likely there to be a run on these funds, so we think it behooves you to apply as early as possible. But again, no one knows for sure if they'll run out or if they reauthorize more money in later legislation. The certification does remain that the borrowers will have to certify that the current economic uncertainty makes the loan request necessary to support their ongoing operations. Recall that with round one, that applied to everyone over 2 million. Because of the uncertainty, they ended up exempting everyone under 2 million if your loan was under 2 million. But that certification will remain. It's not clear though if they're going to exempt everyone. We'll have to see what they come out with later guidance. So eligibility has shrunk. It used to be 500 employees. It's now 300 employees. The alternative size standards do not apply. So if you can't use those other tests to get into the small business concern, or if you have an NAICS code that allows for a larger number of employees or a revenue standard, they do not apply. So 300 employees, unless you meet that code 72, which many of you would here, the restaurant hotel code. The key change here is 300 employees and gross receipts dropped by more than 25% or more during any quarter in 2020 relative to the same quarter in 2019. So you need a 25% drop in gross receipts, which we'll talk about in a moment. It's a very broad term. That's the top line revenue number, minus returns, that kind of thing, or allowances. The affiliation rules will continue to apply as they did in PPP 1, and the same exceptions, the waivers will apply for that code 72 as we talked about. So there's no change with the application of the affiliation rules. If they do apply, you have to apply the affiliation rules both to determine your employee size, your 300 employees, and to determine the drop in gross receipts to make sure you equal or exceed 25%. So that's important to remember for people that the affiliation rules, if they apply to you, apply for both of those tests. There's some additional excluded entities not relevant to the people on this call, so I'll skip over that. Gross receipts is a very broad term. When they use that, it includes all revenue from whatever source derived in accordance with the entity's existing accounting policies. So whatever your current accounting method is, that's the method you use. You can't change it for purposes of determining your gross receipts. And it excludes net capital gain and loss. So if you have a net capital gain that's not included, net capital loss, you cannot deduct it from gross receipts. The loan amount, as we mentioned, still for most people, it's 2.5 times their monthly payroll, capped at 2 million instead of 10 million. For restaurants and hospitality, codes NAICS code beginning with 72. That's the people on this call. They can use 3.5 times their average total monthly payroll costs, but up to that $2 million amount. If you're part of a corporate group, you're capped. The whole group is capped at 4 million. So if you're part of a single corporate group, that group will be capped. Recall it was 20 million in the old program. So they said because the old program was a 10 million loan and they capped them at 20, they put the cap at 4, which is double the $2 million max loan amount. The loan terms are the same as last time, except it's 5-year term. They default you to a 5-year term. So no collateral, personal guarantees, 1% non-compounding interest rate, and a 5-year term. You cannot take this loan if you also receive the shuttered venue operator grant as part of the CAA. That's a new one. And as I mentioned, the application forms are online now. On that, you type in Treasury PPP loan, you'll catch them there in the section for borrowers. So that's the crux of it. Open it now for questions. See where the questions are, if any.
Thanks, Dan. Alana, I think there were a few questions in the queue. You want to run through those for Dan? Alana, you're muted again.
I can. She's still muted. I can see the questions here. I see
Okay.
one. I received 160,000 PPP loan, but I have 300 in payroll over 24 weeks. No, you will get full forgiveness in that case, unless you have significant wage or headcount reductions. That they would come off that the headcount reductions would come off that 300 number, but it would have to be pretty significant to get you below 160. So you should expect full forgiveness in the ordinary course. Next question is a reopening. My understanding is you must spend the loan before disbursement. Yes. So what the rule says is the application, when you look at the application, it has the certifications on there. it says that you must you must certify as part of your PPP2 application that you have used or will use all of your PPP money, including any upsized amount, by the time you are dispersed your loan on PPP2. So it's kind of weird. They should have required it before you apply, because once you apply, you don't know when you're going to get the money, right? If you apply on the 15th of January, you could get your money the 17th, or you could get it in February 28th. So it's a weird formulation, but that's what you have to certify, that you have used or will use all of your PPP1 money. Not that you actually use it, but you have to certify that you're going to use it. So it's a weird construct there.
Dan, how does that impact someone who's eligible to reopen PPP1, but also eligible for PPP2? Do they need to go in some kind of order here?
So that you do have to use your PPP1 money first. And so if you're going to upsize, you have to certify you're going to spend that money before. So let's say your upsizing includes another 4 weeks of payroll, right? You would have to wait 4 weeks before applying for PPP2, because when you apply for PPP2, you have to certify that you have used or will use all your PPP1 money, including the upsized amount. If you know you're not going to use it up until 4 more weeks, you can't apply now, because what if you get your loan in 2 days? You'll violate the rules. So I think it does cause a unique situation. And again, it's not clear because they require that you use the money before you get the loan, not before you apply. So they allow you to apply, but you never know when you're going to get the money. They just drop it in your bank account one day. So it's a strange construct they set up.
And if you're gonna run out of money, if the SBA is gonna run out of money, then you're probably better off applying for PPP2 rather than amend PPP1, right?
Right. We think very few people that are going to need to upsize for PPP1. It's part of the legislation. There was talk that a lot of people missed out on it. There was money left at the end, so I don't know that they did miss out on it. I don't think that's going to be, at least among our client base, probably have. But then again, if they're hiring us, they're reasonably sophisticated, looking for a larger accounting firm. So there may be very small businesses out there who just weren't aware of the program for one reason or another, didn't think they applied. So I suppose there are some out there. We just don't see them, at a firm our size. The other reason, by the way, the upsizing, the other reason is a bunch of partnerships. There was a confusion when PPP1 opened. And so a bunch of partnerships did not include the partners' compensation. So that is a reason why a good number of people may apply for upsizing, because they didn't properly, they thought you could not include it. So when they filled out their application, they didn't include it. They can go back and upsize now. But again, there's an interplay between that and PPP2. And do you really want to wait and risk they run out of money in PPP2? I went through this with a client yesterday on the phone. They had used a small portion of their first loan, and they have to use up the money to get the second PPP. So the question is, what can they use it on fast so they can go reapply for the second one? And even though you have to use up the money, it's not forgivable because the covered period is expired on PPP1. So what I said to them was, you're permitted to spend the money. They wanted to get a tent for one of their restaurants. And I said, you can get a tent. It's not going to be forgivable, but you're spending the money at least, and that'll enable you to apply for PPP2. So it's just a cost benefit decision. Is it worth, if you need something that's you can use, then you would spend the money to get PPP2. If they didn't have a need for anything, to just waste the money and burn it didn't really make sense.
Dan, I see a question out here relative to someone who did not bring employees back, but covered their healthcare benefits. So if those healthcare dollars, and maybe there was some rent or utilities as well paid, right, that would cover towards the PPP. Not quite sure what the question is, honestly, but I guess
those are payroll costs. So that would count as a payroll cost going into that 60%+ bucket.
Right, so you could get the PPP money and spend it on the medical insurance for your employees, plus some of the additional costs, the utilities and rent, depending on that ratio, that 60-40 ratio. So
Right.
that's all covered, even if you had no payroll costs.
Right. I think, and the question may have related to the employee retention tax credit. You know, the key there is they cover furloughed employees now. So even if you don't pay cash to someone, but you're paying their health benefits, right? The typical furloughed employee situation, that's the benefit of that rule on the ERTC, that you can do that. And you can include the healthcare costs in the as qualifying wages for taking the employee retention tax credit, whereas you couldn't before. So that's the benefit of that rule.
Dan, what about new restaurants that opened up in 20? How do they compare their quarterly sales to a prior period? Is there a rule for new startups?
There definitely is a rule. I just don't know it. I didn't focus on that.
Okay.
There's a lot to digest. I read it and then I skipped right over it. I said, you know what, this is not going to come into play too often. But it's in there. There's if you go to that Treasury PPP loan, that first hit on the website I told you, the last IFR, it's about a 42-page IFR. They address it in there, and they talk about how the seasonal businesses calculate it and how new businesses calculate the payroll.
There's a question from earlier. I'm not sure if we hit this one. Can you file amended 941s for 2020 to capture ERTC credits?
You can, but as we talked about earlier, we think they're going to come out with some procedures, the IRS, to make it easier. So it may make sense, I'd say, to wait a week or two and see if anything comes out. I suspect it'll come out in fairly short order. But you can file a 941X and amend.
Dan or Heather, one of the changes was relating to if you got the PPP money, now you can take this employee retention credit, right? So if you qualify, say you had $1 million worth of payroll in, after you got your PPP loan to the end of the year, and you only had 500,000 of PPP, is it literally that simple a calculation? 1 million payroll minus the 500 PPP and the rest of it qualifies for this credit? Or is it each individual employee that their salary was paid with PPP money is now excluded, some kind of a calculation that way?
We capture the earnings on our side. So we look at the earnings bucket, and then you have to look and see, some of the detail in the reporting to be able to come up with the calc.
Yeah,
and it's interesting. Go ahead, Dan.
No, please finish. That was it, yeah.
I was also going to comment on the new business one. I live in Matawan, and I think it's the capital of pizza places in all of New Jersey. And I was inspired to see that there was a new place that opened up, Armano's, across the street from me that's getting rave reviews. But I also wanted to comment, the seasonal business question came up. And we addressed that in our webcast last week because, that definitely caught people's attention, as there were some seasonal businesses that might not have been opened in the spring, but started to open their doors in this environment, and what that looked like from a PPP perspective.
Yeah, too, when you get into that, the allocation of weight, I need to jump in a minute. I'm sorry, I have another webinar at 11. I don't think that's something your payroll provider like ADP can even help you with, because they won't know which wages you used, right? And so they can tell you your total wages for employee retention credit purposes. They can tell you your wages for PPP, but they won't know which you used for the PPP. And so if you use wages for the PPP, you can't then use those same wages for the employee retention tax credit. So that's not something it's not fair to ask ADP to answer that question for you, because they don't have that information. They didn't see your loan forgiveness application, and they didn't monitor that data. So they can give you gross numbers. You'll have to do that allocation yourself.
Right. And when you look in the reporting functionality, again, whether it's us or, obviously there's a lot of companies that's out there. So we probably have a broad spectrum here.
Heather, we don't talk about other companies on this call. It's just ADP.
I'm hoping everybody uses us. But on our side, when you go into the reporting functionality, there is a plethora of different reports pertaining to whether, even on the forgiveness side, as many people, it was interesting, it was very quiet on the forgiveness side, obviously through the fall, but as you all started doing tax planning with the clients, we monitor and saw a wave of usage as people were looking at the 8-week window, the 24-week window. But if you go into your reporting functionality, the entire section on PPP, there's a tremendous drop down from the different ways that you can slice the data to help guide you guys as you close out the year and look forward to your tax planning, coming up, which is on the horizon. I can't believe we're here, but that's on the horizon. So we know there's really productive conversations happening between the restaurants and their accounting professionals right now.
I need to also, Terry, I need to jump for another call, but I put a link in there for the documents for the PPP. So there's a link now to the Treasury website that is all of the documents. The new applications are there for PPP 1 and PPP 2, so for the upsizing and for the new loans. It's in the section for borrowers. And when you go to the program rules, those last two IFRs are the new ones that I talked about. And so the last one is the one that you should focus on for the seasonal and the new businesses. That's the document for PPP 2.
Great, thank you very much, Dan. I thank you, Dan. I thank you, Heather. We have kind of run up to the end of our time frame here, so we'll try and wrap this up. And I will say, anyone on this call, if you have any questions whatsoever, please feel free to reach out directly to either myself or Dan or Glenn. You can certainly find us easy enough on the web. It's Witham, Smith & Brown, witham.com. So first initial, last name at witham.com. Glenn's the same. So you can certainly find us. We're members of the association. Shah, I want to thank you. Alana, certainly, and Glenn, I want to thank you. And let's wrap it up, and we'll be back next month. Please feel free to join us. Second Tuesday of every month at 10 in the morning. We're going to just try and keep things current events, whatever's most current, and kind of keep information available to you guys. So we will.
If there's anything that, I'm sorry to if there's anything that comes to mind that you guys would like us to talk about, please email one of us and we'll add it to the agenda.
Thanks, guys. Thanks, Shah.
Thank you.
Thank you all.
Have a wonderful day.
Thank you.
Thank you.